Today, I want to talk to you about how NAV Decay actually works in covered call ETF funds. This is going to be what I wish someone told me when I was starting out investing in covered call ETFs. So let's get into it. Now, the big misconception in high yield is that your yield is your return. I remember looking at a fund and thinking wow, this pays 80% yield. This is great. I'm just going to park my money here. Yeah, it might go down a little bit, but I'm going to be making so much money off of the yield that I'll be fine. It'll work out. And spoiler alert, it didn't because distributions are not the same as profit. Yield is not the same as total return. And a fund, as I found out, can pay you big money, but they can still destroy your NAV. And we'll go through a few examples of this here. If we look at how covered calls ETFs actually work, they buy an underlying. In this example, I just used SPY for our sake, but they could buy Bitcoin, they could buy gold, they could buy all sorts of things. They sell call options on that underlying. They collect premium from selling that call option, and they pay the investors a distribution or a dividend from that cash flow, from that option. Okay? And then rinse and repeat. They just do that over and over and over again. Sometimes they adjust their strategy. They can change a little bit how they buy. They can change how they sell options on that underlying. But the fundamentals is the same. Okay? Makes sense? Let's run through a very simple example. Let's just say a fund owns $100 of SPY. They sell a call that's 30 days out for $2, so they collect that $2. Ultimately, SPY can really only do three things. It can stay flat, it can go up, or it can go down. So if it stays flat, the fund keeps the premium. If it goes down, they keep the premium too. But if it goes up, they keep the premium only to that, they keep the premium, but they realize the gains only up to that strike price. And we're going to cover that a little bit more as well. But the upside is capped. Another misconception, at least one that I didn't understand right away, is that when a fund makes a distribution or a payment out to the investors, the NAV drops. And this is going to explain that. Let's just say your starting NAV, again, it's $100. Your option premium that you collected is 2, so now your NAV is 102, but then you pay out that $2 to the shareholders, now your NAV is back to 100. And the challenge here is when the underlying goes down, not only do you have to recollect that $2, but your upside is capped. So it's even more difficult for your NAV to recover. Now, let's take a look at a real life example of Bitcoin. And this is going to be a few different funds. Let's just put it up here for you so you can see. This is just the price change only. So this is just the NAV, and I have 3 funds listed. There's YBIT, BTCI, and IBIT. Now, IBIT, this purple line, this is the underlying. This is essentially Bitcoin. I couldn't get it on this chart, but you can just think IBIT is Bitcoin. BTCI is a covered call ETF, and their yield is around 28%. And YBIT is another call ETF, and their yield is around 75%. And you can see the difference in price and outcome of these 3 funds. Now, one thing to draw your attention to, and one thing that I look at, is when the underlying goes up, does the covered call fund go up with it? And you can see as far as BTCI, it does a little bit, not all the way, but of course, but it does go up a little bit, especially compared to YBIT. Even in this period here from April 2025 to October 2025, Bitcoin had a pretty solid rally, but YBIT, at least the price itself, was flat, especially compared to BTCI. It went up, a little over 25%, while YBIT was flat. So to me, this looks like NAV erosion, especially here for YBIT. And you could argue the same for BTCI, but let's look at the total returns here to factor that in as well. So the total returns here factor in distributions. And as you can see, the BTCI is doing pretty well. It's keeping up with IBIT, and YBIT is lagging behind a little bit. You can see even with the distributions, both IBIT and BTCI are around 4%, at least as of this recording, and then YBIT is down 4%. So not super great for YBIT. And again, the yield for YBIT is 75%. So one way I like to think about this is it's kind of like eating itself to pay you out. One other thing that's worth mentioning here is that covered call ETFs tend to do as well, if not better, than the underlying in flat or down markets. You can see that here around, what is this, like September through November, when it started kind of flattening out and then going down. You can really see how BTCI closed that gap in with IBIT. And I just think that's fascinating. And even it inched ahead down here after it fell further. So there are periods of times where the covered call ETFs can outperform their underlying, which is great. Let's move on and cover another example with gold. Now, I have 4 funds up on this one, and it's not 100% apples to apples, but the funds I have listed are KGLD, IAUI, GDXY, and GLD. GLD, this is the anchor, this is the underlying right here, so this green line. GDXY is the cousin of these two, because GDXY is based off of gold miners ETFs, whereas these other two here, KGold and IAUI, are based on gold. So it's similar, but a little bit different, because the GDXY, this is going to be more volatile, because gold miners are more volatile than just gold itself. But anyways, if we look at kind of the underlying here, and we look at the NAV and see how these are doing, what jumps out right away is this purple line here, way down, while these are way up. And if we look at the yield, you'll never guess this, but GDXY has the highest yield of the three at 40%, where KGLD has 10% and IUI has 12% yield. I need to dig more into the details on why there's such a gap between IUI and KGLD, especially when there's not a huge gap in their yield percentages. But what's fascinating here is how close KGLD is to its own underlying. It's looking pretty good. Let's see what the total return shows us. Wow. Okay, so you can see, interestingly enough, GDXY has been leading the way, because again, they're cheating a little bit, because GDX, their underlying, has gone up more than gold. So their payouts has been larger. That said, if we look at the other two, interestingly enough, KGLD is actually outperforming GLD. So it's actually outperforming its underlying, and IAUI has dropped a little bit. It's a little bit lower than that. So if we go back to the NAV here, what's interesting is that even though GDX is up, sorry, I don't have it on the screen here, but it's up about 65%, the NAV is still down. It's still down, even though the underlying is up super high. And the reason for that, again, is because of the yield. The yield is super high as well. So this is something to keep in mind and something to look for when you're looking at other charts. You want to look at the NAV, but you also want to look at the total return. The total return really shows you overall how the fund's strategy is working together. The NAV, or the price change percentage, is going to show you if it's healthy or not, if it's sustainable or not. Make sense? Cool. Now let's look at an extreme case here. Ulti is from YieldMax. This is an extremely high volatility, high yield play. But let's see how this looks on paper as well, shall we? Their total return has been zigzagging. They've been down 20%. They've been up almost 30%, all in the same year. And now they're up slightly, but mostly flat. But if we look at their NAV, their price change percentage, that is, not only is it down, but it just keeps going down and down and down. No matter, they've made a few changes. They made a change in March 2025. They made another change at the end of in December 2025, and they're thinking maybe they could flatten out a little bit, but it still hasn't really helped in terms of NAV decay. And the reason for that is because their yield is around 65%. It used to be much higher. It used to be over 100%, but their yield is so high, even though the fund itself, if you include the distributions, is up a little bit, they're still down significantly because they're essentially taking the money from the NAV and paying it out to you. And because they're paying out so much, they just can't quite keep up. And this is why you might see a chart of Alti or any other fund really, where you can see a chart where the total return is positive, but the price change or the NAV is negative. It's because the yield isn't really sustainable, at least in my opinion, and in this case. So let's summarize this up. What causes NAV decay? It's a combination of things. You have that capped upside from selling those calls. You have over distribution. So if your yield percentage is too high, you're paying out so much money. It's a combination for failure. If the underlying is sideways or down, it doesn't matter with the yield or the upside. It doesn't matter any of that. If the underlying is sideways or down, the NAV is going to be down too. And lastly is a volatility or the strategy. If it just doesn't work well over the long term, kind of like we saw with Alti, if they're whether their underlying or their options that they're selling aren't working right, if it doesn't compound well, you'll see that in the NAV. Now, here's a formula that I wish I knew about when I first started. And that's the change in the NAV, which is essentially the change in your initial investment, is the premium plus your appreciation. Now that can be positive or negative, right, if it goes down, minus your distribution and fees. So one thing that really didn't quite it didn't hit me when I was first starting out is that the distribution also comes from the NAV. For some reason that didn't really click with me when I first started. So hopefully this formula helps clarify things for you, and you can kind of see very clearly that the high yield and the high NAV are they're fighting each other, right? So it's really challenging to have both a rising NAV and super high payouts. It's something that you have to balance a little bit. Now, after all this, you might be thinking, Drew, why would anyone invest in these? Well, there's still a few cases where it will make sense. And if you pair it with uncapped growth, like let's say you buy a high yield Tesla fund and then you buy Tesla stock alongside it, I think that could be advantageous because you get that uncapped growth, but you also get that cash flow along the way. If you just prefer having cash flow to that upside appreciation, or if you're okay just treating the fund like an income tool and not a growth engine. If you're okay with these things, I think they make sense in your portfolio. This isn't financial advice, but honestly, I don't think you should ever go full port into these high yields covered call ETF funds unless you're like at retirement or in retirement. Just because you experience the full or at least most of the downside, but that upside is really hard to claw back. And one other thing that I didn't actually put on this bullet point list is if you like the idea of earning option income and cash flow from things like tech, you can't really like they don't pay dividends in tech. So you really need something like an options tool to earn income from it. And if you don't have, $100,000 or, millions of dollars like these funds do, it can be difficult to have an option strategy without taking up a huge percentage of your portfolio. So what these are great for is you can still mix and match and allocate them appropriately. Because if you're just doing this on your own, you need to, one option is 100 shares. And, a lot of stocks nowadays are $200-$300. That's $20,000-$30,000 that you have to shell out or at least have available to play options on these. So if you don't have a huge account, you want to start getting into it, high yield can definitely make sense. You just have to be smart with it. But hopefully this video helped clarify a few things. I wanted to keep it short, sweet, and simple. So if you have any questions, let me know in the comments. But otherwise, I hope you're doing well. Hope you're staying healthy. And I'll catch you in the next one. Take care.